No color.
Hello? Okay. I don't know. This robocalls are terrible. All right, so let's take a look. And here's our money and banking course. And let's look at week 4. I don't have any friends here today, but the key word this week is guidance. The key word this week is guidance. So let's look at week module 4. Let's look at module 4. Let's talk about monetary policy. Okay. So let's talk about the discussion. I think this is really important. Excuse me.
Responsibilities is to maintain a balance between economic growth and price stability. This is achieved through controlling inflation and stabilizing employment. The Fed's decisions, particularly regarding interest rates, can have profound effects on businesses, consumers, and financial markets. By influencing borrowing costs, the Fed has the ability to either stimulate or slow down economic activity. When interest rates are raised, borrowing becomes more expensive, which can slow economic growth and control inflation. Conversely, when interest rates are lowered, borrowing is cheaper, encouraging investment and spending, but potentially leading to inflation. Understanding how these decisions affect individuals and businesses is key to grasping the broader economic environment. When interest rates are raised, borrowing becomes more expensive, which can slow economic growth and control inflation. Conversely, when interest rates are lowered, borrowing is cheaper, encouraging investment and spending, but potentially leading to inflation. Understanding how these decisions affect individuals and businesses is key to grasping the broader economic environment.
Okay, so let me show you a couple of videos that I created for specifically this. You know, I take economics and I'm a big Fed guy. Because when you work on Wall Street, you have to follow the Fed. There's an old saying on Wall Street, do not fight the Fed. Okay, so let's watch these videos on how the Fed modulates interest rates. Such as video, actually. Let's watch this together. And this is important because it'll teach you, what it'll lead you on is how the Fed actually modulates interest rates. And try to remember this. When the Fed raises rates, when the Fed raises rates, what essentially they're doing is they're making money more expensive for everybody. Money becomes more expensive for everybody. So, for instance, when you want to buy a house, when you want to purchase a car, anything you need to do, it pays, for many people, it pays for them to leave the money in the bank rather than to do those things, because you can get paid more just sitting around, right? That's one way to look at it. The other way to look at it is everything just becomes more expensive. So people buy less houses, they buy less car, They buy less of everything, appliances, because now they have to pay higher rates of interest and it costs them more out of their income. Okay? So the Fed raises interest rates when it wants to slow the economy down, especially now when we have an inflationary period where the Fed wants to stop people from spending money. When we are in a recession and the Fed wants to help the economy, then it lowers interest rates. Okay, so by then everything becomes cheaper. You don't want to leave your money in the bank. Just think of it. It's a simple concept. When interest rates are high, people want to leave their money in the bank and spend less money on goods and services, and inflation should come down. Demand goes down. When the rates are low, people don't want to leave their money in the bank because they're not earning anything, and they either invest in the stock market, buy property, do stuff like that because it's cheaper. So let's watch how the Fed does it. Okay, so welcome again. This is for my macroeconomic classes, and I'll put it in my economics. Basically, I'll stick it in my economics module or my YouTube playlist. But you know, it's the workings of the Federal Reserve, and we know that the Federal Reserve is in charge of monetary policy. So by what they basically do, and it's the most effective way of modulating the economy, and we've talked about it in other texts, in other videos, is that we're looking at if we're in an inflationary time, if GDP is growing too fast, then the Federal Reserve wants to raise interest rates and slow the economy down. And think about how that works. When the Fed raises interest rates, they effectively make you want to keep your money in the bank as opposed to investing in businesses or the stock market, right? It's logical. You know, interest rates are higher. People are going to want to borrow less money to buy cars and houses. They may buy a house and a car, but they'll buy less house and a car. So the economy doesn't grow as quickly. So the monetary policy, and then when the economy's in a recession, like we went through after 2008, well, now we've seen that the Fed tries to keep rates lower, so they encourage people to invest and start new businesses and things like that, because that's what gets the economy going. That's how we pay taxes. That's how people get jobs. And the best way to get an economy going using Keynesian economics, John Maynard Keynes, is to lower interest rates. So the Federal Reserve is at the top of this pyramid, and they have the Board of Governors, which is the governors of each region, and we talked about that in previous videos. And then you have the reserve banks. So the governors and the reserve banks kind of go together, and they watch the different regions in the economy. But what I want to talk about today, and you can get that in previous videos, but what I want to talk about today is the Open Market Committee, because it's the Open Market Committee that's basically the trading desk of the Fed. So when the Fed gives the Open Market Committee an order, they will conduct the nation's monetary policy. And what does that mean? What does it mean that they trade? How does the Fed trade? Well, when the government needs to buy bonds, when the government needs to borrow money, right? If they spend more than they're taking in taxes, they need to borrow money. And the way the government does that is through the Fed, which is the central bank. They will sell, they will, to control a recession, what they'll do is they will buy back bonds. Well, let's start with the inflation. The economy is growing too quick, and the Fed wants to slow it down. Well, effectively, what the Fed does when they need to borrow money is they sell bonds. Effectively, what they do is they borrow money from people by issuing bonds, which are basically tradable loans. No different than any other loan. It's a tradable loan. It's a treasury bill, a treasury bond. Depending on the length, it's either a bond or a bill. If it's 10, 5, 10, 30 years, it'll be a bond. If it's less, it'll be a bill. But in order to control, so what the Fed will do is that the Open Market Committee is when they want to borrow money, they will sell these bonds to the public, and the public will give them the cash, and in effect, they're borrowing money from they're borrowing money from the people or from the banks. And, you know, when they borrow money from banks or they borrow money from insurance companies, whoever buys them, it's basically our money backing that. Because think about it, where does an insurance company get their money? They get it from the premiums we pay, right? And then they invest them, and then they pay out when people have a liability, you know, car accident or life insurance, property damage. But they invest that money. So it's basically our money they're investing. Or if you put your money in a 401k or buy a mutual fund or get it swept in a bank account, the institutions, the intermediaries are investing. But effectively, they're investing our money. That's where they're getting most of the money. Some of it is corporations, but a lot of it is personal money. So now you get the idea. When the Fed wants to borrow money, they'll sell the bonds and take cash in. And when they And that also acts as a way to control inflation. And how does that work? Well, look at this. The Fed will sell bonds to these banks or intermediaries or individuals, the interest rates will go up because in order for people to want to buy these bonds, the Fed has to offer higher and higher interest rates. It's a classic supply demand problem. The higher the interest rate, the more you'll want to buy these bonds and keep the money out of the economy and put it in a bank or in the bonds themselves. So, the banks will pay higher interest and the government effectively pays higher interest. And the government is actually the safest investment because the US government is the safest investment on earth, given our military power and our infrastructure. But also banks are very safe and a lot of AAA companies like Coca-Cola and IBM are very safe. So our interest rates go higher, but so the bonds get sold to these banks, interest rates go up, and then what happens is when the interest rates go up, it slows the economy down. So it's not just a way for the government to borrow money, but through open market operations, it would be a way to slow the economy down and control inflationary pressures. So again, when they want to control inflationary pressures, they sell these bonds to the banks, and in turn, the individuals or the companies or the insurance companies will buy these bonds, and they will raise interest rates because the more bonds that the government wants to sell, the higher the interest rate has to go. So that kind of gives you an idea of how the open market committee acts. So when the Fed actually wants to slow the economy down, they will sell more bonds to the public and take cash out of the economy. And on the other side, when we have a recession like we experienced after 2008, and the government actually wants to lower interest rates to get the economy moving, well, then what they'll do is they'll buy these bonds back from the public. And when they buy these bonds back, and I'll get into the math in another video, and we'll do present value assumptions. But going through some of my other bond videos, we know that if the government wants to buy back these bonds, they have to offer better and better prices to the traders or to the banks. If you bought the bond at $100 or $1,000 per bond, and the government turns around and says we'll pay you $1,100, there's an encouragement for you to make a profit and sell it back to them. But the higher price means that the interest rate is lower. And you remember that from our present value calculations. Interest rates are lower because now the government is buying back these bonds. And so they're lowering interest rates, they're raising the prices of bonds. So the bonds go back into the central bank, and cash goes into the economy, and now more cash is available. So the banks, in order to get rid of that cash or to make a spread on that cash, because how does a bank make money? They take your deposit and they lend out the money through mortgages, car loans, business loans. They have to lower interest rates, and the lower interest rate spurs the economy, encourages investments in stocks through margin loans in companies, because people don't want to leave their money in the bank, so they start a company, they invest in companies. So you start to see the basics behind central bank and open market operations. So once again, to recap, when the Federal Reserve through the Open Market Committee wants to slow the economy down because they're worried about inflation and that the economy is going too fast, they will sell bonds or effectively borrow money and take cash out of the market. And given the inverse relationship, the more bonds they want to sell, the higher interest rates they have to offer the public or the investors, and that will raise interest rates and slow the economy down. High interest rates. When they want to get the economy going, like we're experiencing now, they will buy bonds back at higher prices, and the higher prices imply lower interest rates. And low interest rate. And the basic thing you want to take away from this, even if you don't want to be a economic genius, what you want to know is that when rates are low, people will invest in stocks and companies, buy more house, buy more car, buy more things on credit because rates are low. And when they want to slow the economy down, they will borrow money, crowd out the normal investor by borrowing money and raising interest rates. And what they'll do effectively is slow the economy down. So that's the basics. We'll have more videos. Go to my economics and my finance channel, and a lot of this will be here. But that's the basics. And we'll talk more. Thank you. Now that's one. That's stuff.
Okay.
We don't want to hear
So
this.
this
This is something else. Now I want to show you one on how the Fed actually works.
This is a video that explains or attempts to explain from an introductory level, the workings of the Federal Reserve System. The Federal Reserve Bank is the central bank of the United States.
Hopefully you can hear it, but
It's
I
one of the
have the
largest
I
central
have the
banks in the
closed
world,
caption on.
since we have almost a $25 trillion economy. The Federal Reserve is their main purpose is to modulate and protect the integrity of the United States currency, the dollar. So what the Federal Reserve attempts to do is to make sure that inflation does not get out of control, and I'll explain that in a minute, and also that the economy doesn't slow too much, which is what they're dealing with right now. The Federal Reserve is led by Janet Yellen. She's the first female head of the Federal Reserve and an economist by training. The, uh, she is the head of the Board of Governors, which is 12 regional bankers and herself, together with these different advisory council, the Federal Advisory Council, the Consumer Advisory Council, the Thrift Institutions Advisory Council, the advisory committees. They're basically made up of business people, people from academia, government officials. They weigh in on the inner workings of different parts of the economy within the United States, help the Board of Governors make decisions on whether to modulate interest rates by either raising them to slow down the economy or lowering them to increase velocity in the economy. This board of governor, this board of governors, they oversee the banks, the member banks, and all member banks within the United States, and they set their rules for the banks. So there you have it. They have a board of governors. There's the Open Market Committee, and the board of governors of the Fed oversees the Open Market Committee. What the Open Market Committee basically is a big trading desk. And when the Fed wants to modulate interest rates, their number one tool is to use the Open Market Committee. Now, the Open Market Committee will buy Treasury securities to lower rates and sell Treasury securities to raise rates. So think about it like the Fed having an open checkbook. That's the only entity in the country that could just write checks or create money. Obviously, if they create money too quickly, they're going to create too much money. Imagine if everyone had $1 million in their bank account tomorrow. Sounds like a great idea, but the price of bread would probably, a loaf of bread would probably become $100 or $200 because there'd be too much money chasing too few goods. That's a dramatic example, but the example of what inflation means in an economy. So it's the Open Market Committee that buys Treasury securities when they want to lower rates. By buying the securities, they're actually giving the banking community cash. And remember that interest rates are an inverse function of demand. In other words, when there's a lot of cash looking for lenders, think about this for a minute. When there's a lot of cash looking for lenders, interest rates will go down because there's more cash than people who want to borrow. And that's what the Fed is doing right now. They're flooding the markets with cash by buying Treasury securities and lowering the rates of interest. And if the rates of interest are low, you're not going to keep your money in the bank. What you're going to do is invest in either businesses or buy capital goods or buy homes. That's the hope. In this economy, recently we haven't seen that because of the regulatory and the banks coming out of 2008 are not lending they're lending to large borrowers, but they're not lending to smaller borrowers. So that's created an issue for the Fed, and it's created an issue for the economy. But that's what they do. And then when they want to raise rates, because inflation is getting out of control, almost like when you hit the brakes on a car, then they will sell Treasury securities and take cash out of the market. And the Open Market Committee does those things. So thinking about it, they sell the securities. In other words, they're borrowing more money. They're taking cash out of the economy. Because less cash is chasing more borrowers, think about the supply demand economic relationship, rates will go up. And when rates go up, it pays for you to keep money in the bank and not invest in homes or businesses or the stock market. So you see the stock market doing very well right now because rates are so low, and there really isn't an alternative to investing in the stock market, which is not the best reason for buying stocks. You'd rather see just solid earnings. Low interest rates are not the number one reason why you want to buy stocks. You hate to do something because there's no other way to do it. The other thing you should be aware of, these are the 12 central banks. And you see basically what we've done is divided the economy in 12 regions. The original banks, almost like the colonies, it kind of reminds you of that. You have Boston Bank, you have the New York Fed, New York being a financial center. the Philadelphia Fed, the Richmond Fed, which kind of handles the Mid-Atlantic states. You have the Atlanta Fed, which has Florida and Atlanta. The Chicago Fed, and Chicago being one of the central parts. You have the commodity exchanges. A lot of the markets come out of there. There's St. Louis Fed in the central region of the United States, the Dallas Fed with the oil economy, the Kansas City Fed with the Midwest economy, Minneapolis Fed, Minneapolis, the large amounts of natural resources in that region, and Borders Canada, which is our largest trading partner, by the way. And then finally the San Francisco Fed, which handles the vast West. And of course, we know we have technology, military contractors, entertainment, tourism, agriculture. Las Vegas is located there. A lot of business comes out of the West. So you have the 12 central banks, and that's how the Fed divides up the economy. So interest rates are the main purpose. The Fed has some other tools in their economy and in their arsenal. One would be the discount rate, and the discount rate is the amount of money that member banks charge each other. There's the Fed funds rate. There's overnight borrowing by banks. Think about the banks in this country as having these big checkbooks, and at the end of the day, all of the um, transactions that occur with our money cards, with our checkbook, paying bills, collecting money from your employer or from another business person, all these things get netted out at the end of the night, and if a bank needs money, they're able to borrow it from the Fed or from other member banks. Those rates, the higher they are, the more reluctant banks are to lend money. The lower those rates are, like the discount rate, the the uh, the more aggressive banks will lend money because rates are lower. Basically, their source of funds has gone down. So the discount rate, the federal funds rate, those are all ways for banks to source funding to lend. Um, the other tools in the Fed's arsenal are the margin requirements. That's how much money you have to put up to buy stocks. That hasn't changed much since 1929. It's basically 50%. And then there's jawboning, which is basically verbiage from the Fed bank governors, where they'll talk about the economy. In a slow economy like this, they'll talk up the economy, and in a very booming economy, they'll talk down the economy. But the one thing you have to realize is interest rates are a function of demand, and the more cash out there chasing less lenders, the lower the interest rates are going to go. The less money and the more lenders, the supply demand function is going to turn, so rates will go up. And when rates are high, people will leave their money in the bank. Makes sense, especially fixed income or retirees. But when rates are low like they are now, retirees are getting very little from Social Security. They're not earning a lot of money from their retirement accounts. So ergo, or therefore, they are going to put money into the stock market. That's the yield curve. And the yield curve is a visual view. It's a normal yield curve. On this axis, on the y-axis, you have the yields, which go from 0 to 3.5%, and on the x-axis, you go from zero maturity to 30 years, and you can visualize rates going up. Rates are a function of time. Think about it. The longer you want to borrow money, the more you generally have to pay. Credit, the better your credit, the lower the rate. The worse your credit, a company's credit, the higher the rate. So you got time as a factor in interest rates. Your credit, like your credit score.
Okay, so remember that we could stop there. That the word interest rates, higher interest rates, the Fed is slowing the economy. Lower interest rates, the Fed is urging on the economy. Now let's look at this week's assessment. The tools of the Federal Reserve, we talked about that. Okay, we talked about that. Here's your assignment. What is the Federal Reserve's role? It's all here for you. I just went through the videos. Okay, you could watch them again. You just go right to my channel. Guidance is the key word. Guidance is the key word. I'm going to stop sharing for a moment. Guidance is the key word. If you go to your assignment, let me share that. You go to your announcements. Here's your week 4 assignment guidance. Here's how you structure your paper. Here's how you write it. And once again, all you have to do, if you want to go over my video again, is I'm going to send you one video and I'm going to put that in the announcements, and that should cover you for the week. But guidance being the key word. Guidance is the key word. All right, but I'm going to put that video in here too for you folks. Okay. You guys are great, I got to tell you. All right, so that's it for this week. Get it done. You guys are doing good work. Let's finish it up. We're getting down to week 6 already. So let's get it done. Very important you get your work done. All right. It's always a pleasure. We'll talk soon.